A leading lithium battery company that invested over 10 billion yuan has announced a halt in production. Just take a look. The entire facility spans over 32 acres with dozens of factory buildings. This company used to have an annual output value exceeding 10 billion yuan, with over 3,000 frontline workers and more than 5,000 local employees overall. But before October 1st this year, they voluntarily announced a halt in production. All their equipment was top tier, using the best domestic brands. I honestly never thought a top lithium battery company in China would cease production. This company specialized in producing 280 ampere-hour aluminum case energy storage cells with an annual production capacity of 12 gigawatt-hour. The equipment we acquired includes Ross 650-liter mixers, fully automated feeding systems, Catl 750 by 39-meter extrusion coaters, and Nako and Haiyu 800 roll-cutting integrated machines. The investment in just this equipment alone was 2 to 3 billion yuan. With even well-established leading companies cutting back or shutting down production, you can imagine the situation for second, third, and fourth-tier manufacturers. Amid the challenging economic environment and declining market demand in China, the lithium battery industry is facing significant struggles, including overcapacity, low utilization rates, excess inventory, and continuous declines in product prices. These issues have forced many companies, including industry leaders, to halt production. Industry analysts suggest that the sector has entered a period of consolidation, with expectations of large-scale production cuts and many companies exiting the market in the near future. Recently, the 21st Century Business Herald compiled financial data for the first half of the year from 9 major A-share and H-share listed battery companies, including Catl, Eve Energy, Sunwoda, Goshen High-Tech, CALB, and Ferrosis Energy. These companies collectively reported 266 billion yuan in revenue and 26 billion yuan in net profit. Catl alone accounted for over 60% of the total revenue and nearly 90% of the net profit, while the remaining 8 companies earned less than 3 billion yuan combined. One notable trend was Catl's 12% drop in revenue, marking its third consecutive quarter of decline since late last year. A report from UBS on September 11th, titled China Lithium Prices Bottoming Out, revealed that Catl decided to halt its lithium mica operations in Jiangxi as of September 10th. The decision stemmed from the continuous decline in lithium carbonate prices, which had dropped below Catl's mining cost of $10,968 per ton. According to Shanghai Metals market data, since mid-July 2024, the spot price of lithium carbonate has consistently stayed below Catl's cost line, leading to 2 consecutive months of losses in the company's lithium business. UBS noted that suspending Catl's operations in Jiangxi would cut China's monthly lithium carbonate output by 8%, or 5,000 to 6,000 tons of lithium carbonate equivalent, potentially providing a lift to prices. On September 11th, Catl responded, saying it was adjusting production at its Jiangxi facility based on recent market conditions, though it did not specify if this adjustment meant a complete halt. Earlier this year, rumors about a production halt at the mine were denied by Catl. However, UBS pointed out that while previous claims were speculative, the latest reports appeared more reliable. In addition, the National Business Daily reported that Catl declined to comment on the inquiries. An industry source confirmed to the outlet that Catl had indeed stopped production at its Jiangxi site. Following this news, Zhuling Lithium, another major player in Jiangxi, also announced a halt for maintenance on September 11th. A representative from a local industry group said, "This production halt is a natural response to market conditions. Given the current oversupply of lithium carbonate, with prices dropping below production costs, it's not surprising to see companies reduce or stop production." The representative added that if lithium prices continue to decline, more companies may halt production and less efficient players could be forced out. This market adjustment could extend well into next year. In 2022, Catl acquired their exploration rights to the Jianxiawu mine in Jiangxi Province's Fengxing County for 865 million yuan. The mine holds 960 million tons of resources, including about 2.7 million tons of lithium metal oxide, with an average grade equivalent to 6.6 million tons of lithium carbonate. The first phase of production at the mine was completed by mid-2023 with an annual output of 42,000 tons of lithium carbonate. Industry estimates show that CATL's 3 refineries have a combined monthly production capacity of 5 to 6 kilotons of lithium carbonate equivalent. A representative from a leading lithium refinery in Yichun of Jiangxi province said, "If CATL's production costs in Yichun are over 90,000 yuan per ton, they can't sustain it. Other companies will find it even tougher. Currently, the overall operating rate for lithium salt factories in Yichun has dropped below 50%. If even cost-efficient players like CATL and Juling Lithium are halting production to stabilize prices, it could significantly reduce output and affect overall supply." Public data indicates that Yichun produced 158,000 tons of lithium carbonate in 2023, making up 35% China's total. Since the beginning of this year, prices have consistently stayed below 100,000 yuan per ton, a level that has breached the cost line for most lithium mica extraction companies. CATL's struggles are not unique. As lithium carbonate prices have continued to fall, upstream mining companies have been hit hard, especially in the production of battery-grade lithium carbonate. Losses have spread across the sector. In the first half of this year, Ganfeng Lithium reported a 760 million yuan loss, marking its first mid-year loss since going public in 2010, with revenue down 47%. Tianqi Lithium saw 6 billion yuan in revenue, down 74%, with net losses of 5 billion yuan, a 181% year-on-year decline. Since its peak in September 2021, Ganfeng Lithium's stock has plunged more than 80%, with a 37% drop this year alone. Meanwhile, Tianqi Lithium's market value has also fallen by 80% from its peak, with a drop of over 50% this year. An article from Huaxia Energy Network on September 8th highlighted a continuous decline in the sector's utilization rate. Overall, capacity utilization was 76% in 2022, fell to around 50% in 2023, and dropped below 50% in the first half of this year. As a leading company, CATL maintained relatively high capacity utilization rates, but still felt the impact of industry-wide overcapacity. In the first half of 2022, CATL's rate was 81%, falling to 70% in 2023, and further down to 65% in the first half of 2024. Across the supply chain, declining prices have put significant pressure on companies. Dongguan Securities reported that in the first half of 2024, the lithium battery industry generated 432 billion yuan in revenue, down 13.5% year-on-year. The first decline in the past 5 years for this period. Net profit attributable to shareholders was almost 31 billion yuan, a drop of 12% year-on-year. The most significant challenges within the lithium battery supply chain are being felt by battery materials manufacturers. In the first half of this year, leading companies like Hunan Yuneng saw their profits nearly halved. Tianqi Materials, a major player in electrolyte production, reported an 81% drop in profits, while BTR, a top producer of anode materials, also faced declines in both revenue and profit. Beyond low capacity utilization and declining performance, lithium battery material companies are grappling with high inventory levels. When lithium salt prices were high, many companies stockpiled large quantities, anticipating further price hikes. However, prices soon began to plummet. For example, lithium carbonate, which was over 500,000 yuan per ton in 2022, has now dropped below 70,000 yuan per ton. An article by Auto News Media, Gasku, on September 28th, highlighted that the battery industry faces fierce competition not only in technology and products, but also in pricing. The ongoing drop in lithium carbonate prices has further squeezed already thin profit margins. Lian Rui, vice president on Sunwoda, noted that lithium carbonate prices fell by 80% last year, while lithium battery prices dropped by 50%. But this year, the situation has worsened, with the price of energy storage cells falling to 0.3 yuan per watt-hour and power cells down to around 0.5 yuan per watt-hour, dangerously close or even below cost levels. Guotai Junan Securities predicts that the lithium battery industry will see production cuts, shutdowns, and bankruptcies. Recently, Svoldt Energy chairman Yang Hongxing stated that the market is accelerating its consolidation. He predicted that by the end of this year, around 50% of the energy storage companies may exit, and there could be fewer than 40 power battery companies remaining. The phase-out is likely to continue into the coming years. Yang also pointed out that 2024 marks the beginning of a significant adjustment phase for the lithium battery sector, with issues like overcapacity, tighter financing, price competition, and operational difficulties all surfacing this year. Data from the China Automotive Power Battery Industry Innovation Alliance showed that from January to June, China produced a total of 430 gigawatt-hour of power and other types of batteries, up 37% year-on-year. However, the total installed volume was only 203 gigawatt-hour, up 34%. Despite growing in production and installations, the ratio of installed volume to production has fallen below 50%, indicating significant inventory pressure across the industry. Cui Dongshu, Secretary General of the China Passenger Car Association, said, "In recent years, power battery production has continued to increase, but the installation ratio has been declining." He explained that in 2021, the installation ratio was at 70%, but it dropped to 54% in 2022, further declined to 50% in 2023, and reached just 47% in the first half of 2024. As early as 2023, a seasoned professional in the lithium battery sector told Shanghai Securities News that rebates on lithium mining became a turning point for the industry's trajectory that year. Catl attempted to secure sales by offering discounts, but its half-price strategy led to market expectations of further declines in lithium prices. In anticipation of lower prices, downstream buyers reduced their purchases, which caused lithium prices to begin softening. This drop in prices further reinforced the expectation of continued declines. This feedback loop of price-cutting expectations, combined with high inventory levels downstream and discounts on fuel vehicles competing for market share, ultimately led to a sharp decline in lithium prices. By late December 2023, battery-grade lithium carbonate prices had fallen to around 100,000 yuan per ton, marking a 70% drop for the year. The 10th G20 Lithium Battery Summit communiqué in late November 2023 also warned that China's lithium battery industry has entered a phase of cyclical and structural overcapacity. However, back in 2022, the industry was far from the bleak outlook it faces today. Aggressive government policies fueled rapid growth in the new energy vehicle sector, which in turn drove the expansion of battery companies. A manager of a battery pack factory in South China once described the frenzy. "It felt like anyone could jump into the battery business. With stories of quick fortunes making the rounds, speculative money kept pouring into the lithium sector. Shu Yu, an investor in lithium resources, mentioned that speculative behavior was rampant throughout the supply chain, with raw materials being hoarded everywhere." 2022 was also a peak year for expansion in the power battery industry. According to statistics from Gaogong Lithium, there were 44 new projects launched for power and energy storage batteries, with a total planned capacity exceeding 1.2 terawatt-hour and planned investment over 430 billion yuan. 16 projects were completed and operational. The downturn began in the fourth quarter of 2022, driven by a sharp slowdown in new energy vehicle sales growth. As a key driver of battery consumption, any drop in end-user demand directly impacts the entire lithium battery supply chain. Founder of Real Lithium Research, Mo Ke, explained that the rush to expand led to overproduction of around 100 gigawatt-hour in power batteries, which would be enough to power 2 million vehicles based on an average of 50 kilowatt-hour per electric car. In 2023, managing this inventory became the primary challenge for power battery companies. An executive at a leading battery company told Time Finance that declining orders have led to lower capacity utilization, a widespread issue for most power battery manufacturers. A recruiter specializing in lithium battery sector noted that in the industry is clearly less buoyant than in mid-2022 or the same period in 2021. The oversupply situation in the lithium sector is now affecting all aspects of the supply chain. Reports indicate that partial shutdowns have become the norm, with ongoing news of production suspensions, layoffs, and wage cuts. On April 1st, Yichai reported that a vice president at the upstream lithium company in East China disclosed, The key issue is a lack of work. Even the boss is looking for a stable job. He added that throughout the new energy industry, from top to bottom, there are no orders and partial shutdowns have become common, causing sleepless nights for company owners. Catl has also seen some staff departures due to insufficient orders. He further noted that early 2024 orders are even less than during the same period last year. If companies fail to secure new orders in the next 2 months, the first half of the year might be a washout. Jiangsu Province's Changzhou City, a hub for leading battery companies like Catl, CALB, and Volt Energy, is also home to various upstream and downstream companies in the battery and new energy vehicle sectors. Each year, many young people flock to the city for jobs. However, this year, the situation is different. A young man from Hebei province shared that many factories are either not hiring, offering lower pay, or requiring grueling shifts, prompting him to return home. The lithium battery industry is undergoing a major shakeout, and many small to mid-sized companies failed to survive last year. Now, even big players are on edge. Industry insiders caution, everyone talks calmly about the shakeout, but it is brutal. It means not just a company or a brand disappearing, but the loss of thousands of jobs and billions in investments. Amid weak domestic demand and overcapacity, China has been offloading a large number of lithium batteries overseas to boost the economy. Reports indicate that in 2023, China supplied 81% of the global lithium battery output, with 37% of its production exported. From 2020 to 2023, China's lithium battery exports grew 7.2 times, and its market share outside China increased from 26% to 65%. Roughly 57% of these exports went to the US and the EU. In 2023, China exported $23 billion worth of lithium-ion batteries to the EU, along with $19 billion in solar panels and $14.5 billion in electric vehicles. This oversupply has led to a global glut in lithium battery production. An analysis by the Atlantic Council in May last year urged the EU to selectively and thoughtfully apply greater tariffs and restrictions to curb the dumping of Chinese products like electric vehicles, solar panels, and lithium batteries. The report stressed that EU tariffs targeting electric vehicles and batteries are economically and strategically important, noting that these industries provide nearly 14 million jobs across the bloc, which is 6% of its workforce, making them vital economic drivers. Chinese subsidies for car exports, the report noted, put these sectors at risk. A political commentator based in the US, Tang Jingyuan, said the Beijing strategy of using massive subsidies to support dumping of low-priced goods overseas is a long-standing tactic. This approach allows China to dominate markets, gain leverage, and secure greater economic benefits. However, these practices have alienated China from the free world and accelerated its economic decline. By dumping products overseas, China is trying to alleviate domestic overcapacity, but its external markets are being jeopardized by its own actions.